Let's get our market master for the day. Saurabh Mukherjea, CEO, Institutional Equities at Ambit Capital, joins in. Hi Saurabh, good morning and Happy New Year to you.
Same to you.
I'm sure you've been waiting for this kind of an opportunity with open hands to buy into this market. But what would the advice be to investors? Not get worried and keep buying?
I think look, in all market rallies or slides, really, you have to sort of extract the underlying structural change, the underlying structural pattern from what is noise. And we genuinely believe that the events of December, when the Parliament wasn't able to get legislation done, I think that is more noise than the reality. My sense is that policy making is happening, the economy is recovering. I think this steady flow of economic data suggests that we're in the first year of a cyclical upturn. And in that context of policy making, constructive policy making taking place, of an economic recovery, I think it behooves us to continue being positive on India. We've been buyers of the Indian market for the last couple of years, and we're fairly confident, comfortable buyers of India today.
Hi Saurabh, good morning. Today Sensex is down close to about 400 points in pre-open, and this is a global linked sell-off. Do you see a correction in the offing for the Indian markets, and if yes, how deep could it go? Because the last one was fairly shallow.
Look, I mean, short-term market movements were never our forte at Ambit Capital. Our strength has been longer-term perspectives on India, both from an economic and from a stock market perspective. And whilst we've seen over the last 3 or 4 years again and again that on global sell-offs, India does get pushed down, but because of the strength of the economy, because of the strength of the structural changes in our country, the market does come back. So days like this, we tend to go back to our good and clean portfolios. We go back to our well-run, well-managed, cash-generative Indian franchises, and we keep telling clients to buy those. So I don't think we'll be doing any different today. We tend not to worry too much about sell-off days like today. We tend to focus on the bigger picture. And as I said, the bigger picture is fairly encouraging. I spent a full day in Delhi meeting a broad ecosystem of policy makers, policy experts, newspaper editors, and I think that the picture in Delhi is that policy making is happening at full throttle. And my sense is we will get a much better budget session than we got in the winter session. The 3 ordinances, now 4, I think. So it's coal, land, insurance, and the mineral, the MMD are added to that. The 4 ordinances, I think, will become law, and there's a reasonable chance that the GST constitutional amendment might actually go through at least one of the 2 houses. So lots happening. Positive picture on the economic front as well. I think we've seen the PMI data, we've seen the IIP, the industrial core numbers pick up a little bit. It's early days for the economic recovery, but I think it's a clear recovery underway. And when we speak to a broad range of companies, from say toll road operators, cement manufacturers, industrial companies, you can see the early signs of an upturn there.
Okay, so the key question is, what do you buy now? Just to analyze one by one, this MMDR Act, who are the key beneficiaries for this, and how would you really play this news?
So I have to confess, I haven't seen the fine print as yet. My sense is that this is an amendment of the existing.
Okay, so summarize all the ordinances that have come through and who the key beneficiaries could be.
So I think the biggest positive I would take away is the Land Acquisition Act amendment. The fact that whilst the government is not changing the commercial terms of land acquisition, the process is getting made smoother, I think will be something that the industry will see as a positive sign. Whilst India promoters will wait for this to become law before they actually start investing in fresh land, the fact that the government is doing this I think is a very powerful symbol. I have to confess, a month ago I didn't think land reform would come this early. I had thought that the BJP would wait till the monsoon session next year before they bought land reform through. So the fact that they've bought this early, I think, is a big positive. I think FDI insurance, I think, has been discussed endlessly. I don't think any of us expects FDI to come in on the back of the ordinance, but to the extent the ordinance does look like becoming law in the coming session, my sense is anywhere between $5 to $10 billion of FDI will come in on the back of the 26% going to 49%. I think coal ordinance, it's obviously being done to allow the auctions to happen, and hence from that perspective it's difficult to see this not becoming law. But I think the even more noteworthy part of the coal ordinance is the way the sector is being liberalized, and private sector participation in the coal sector is being allowed. It's a less discussed part of the coal ordinance, the fact that this is actually the liberalization of the coal sector. sector. Perhaps that's why the Coal India workers are a little bit tense about the ordinance. But I think this is the liberalization of the coal sector, and I think it bodes very positively for the country. If you add up the coal auctions this year plus the coal auctions next year, and if you look at the coal minister's production growth targets, you're likely to see in the next 2 to 3 years something like 300 to 400 million tons of extra coal being produced in India. That's a 40-50% jump in our coal production. That's big stuff. So again, what tends to happen in our country is we tend to focus either on all the positive news and we get very excited and the market runs away, or we go through bouts such as the one over the last 2 to 3 weeks where we get very tense about global events and local politics, and we become very bearish. I think we're in a little bit of the latter pattern, and that's good for long-term investors.
No, but because of this higher coal production, would you buy any of the power companies? I mean, that's been a space that everyone's avoided for a long time now.
So I don't have sign-off from my compliance team to discuss stocks, but what I can say is I think what's emerging from our discussions with policy experts in Delhi is that there's a very clear plan that the government seems to have, which is to take the power sector, take the utility sector into a regulated ROE framework. So most of the utility companies I think will have to sign up PPAs. In the PPAs they'll get something like a 15% ROE. Now if you're a power company, and there are several who've struggled to generate ROEs of any meaningful shape or form, 15% ROE is actually very good. Second big benefit I think for the power sector of this sort of construct, where the government is pushing you towards a stable regulated ROE type construct, is I think global pension funds, REIT buyers will become much more interested in buying the underlying asset. So if you can take a power plant, get the construction risk out of the way, and then sell off the cash flows through a REIT construct, I think in this regulated ROE type world which we are moving towards, I think there'll be plenty of buyers. My hunch is with the road sector as well, I think we're going to see a similar construct where the construction risk is borne by the government, but once the toll road starts producing cash flows, REIT buyers and pension funds will come in. So for roads and for power, for the roads and for the power sector, I think the changes that are afoot are fairly fundamental. Remember, the whole PPP construct was that the private sector would take risk, the upfront construction risk. I think the government is saying no, that's not working out. Let's switch it back to the government taking construction risk and selling off the cash flows. So I think for the power utility sector, it's a big development, positive development. For the coal sector, I think we've got positive news afoot. The whole land acquisition bill, I think, bodes well for cyclicals generally, and hence I think it makes sense on a day like today to look at that screen and look at some of the stocks you're showing there and say this is as good a time as any to buy some of these names. I mean, 20-25% upside on some of the power utilities I don't think is unrealistic in the context of the policy changes that are being discussed in Delhi at the moment.
Saurabh, what's the call for the earnings season? What could be the earnings downgrades, upgrades, downgrades ratio, and how will it change the Sensex EPS earnings post this one?
I think for a while now, I've emphatically made the point that earnings downgrades and upgrades and GDP changes on a quarter-to-quarter basis, the impact on the market is fairly modest. But just to put some numbers around that, our estimates for Sensex EPS growth in the current fiscal have been in the vicinity of 12-13% for a while. I don't see any great reason to change that. I don't think, whilst there's an economic recovery underway, I don't think it'll have a dramatic bearing on this quarter's earnings, the Q3 earnings season that we're going to enter. I think next year's earnings growth you're going to see somewhere between 15 to 17% next year. Credit growth of I think around 15-17% against. Remember, credit growth at the moment is running at something like 11%. My reading is over the next 12 months you go towards a mid-teens figure. So you're seeing economic growth resulting in modest improvements in earnings growth. Just to put this in perspective, just to put mid-teens earnings growth in perspective, I think between 08 to FY8 to FY13, I think we barely had 4 or 5% earnings growth.
Yeah.
So in that context, mid-teen earnings growth is a lot to write home about. I know all of our minds are fixated on 04 to 08 when we had I think something like 25% earnings growth. But mid-teens earnings growth for an economy growing at around 5.5-6% is pretty healthy.
Yeah.
Pretty healthy. So it's a backdrop of economic solidity. Yes, there will be global gyrations, especially as we get closer to a Fed hike. But I think those are events on which one buys India. As I've written several times, almost every episode of US monetary policy tightening in the last 25 years has been good for the Indian market. I don't think it'll be any different this time.
Okay, I hope our viewers are listening to you. So finally, we don't have too much time with you. I understand you have another meeting. So tell us, have you tweaked your year-end target? I know it's very early days, but since global markets have thrown a bit of a shock in the last couple of days, would there be any changes at all to your year-end targets?
So our FY 15 end target remains 30,000. It's been 30,000, I think, pretty much from election day.
Yeah.
Of our FY 16 year-end target, we announced our FY 16 year-end target around a month or so ago, and that's 36,000. So FY 15 year-end, we're looking at 30,000, but that's been our figure for a long time now. And FY 16 end, we're looking at 36,000.
So that's 30,000 by March?
By March, and then 36 thereafter. And just to put some historical context around it, if you look back at the last 30 years of the Indian market, or indeed the last 20 years, the Sensex typically compounds at 16-17%. But if you look at the first 3 years of Indian economic recoveries, the first 3 years, the Sensex gives you between 30 and 35%. I think it's a very similar pattern that's getting replicated this year. You're getting a cyclical rally on the back of a decisive election result, a pattern that's been seen in India decade after decade. Decisive election result followed by a cyclical rally, by a cyclical recovery, followed by the Sensex compounding at between 30 to 35% for around 3 years. My sense is we are firmly within that construct. There's nothing particularly untoward happening. We're firmly within that construct, and there's a lot of solidity, therefore, I think, in the recovery, both in the market and the economy that's taking place.
All right, Saurabh, thanks so much for taking the time out and joining us today. So that's the view coming through from Ambit Capital. Not too worried about these 1 or 2 day sell-offs in India. Firmly remains a market that one should buy into, and those are their targets.